This year, as I think we all know, Asia has not done that well. We had a very strong start to the year when the overall MXAPJ index was up well over 10% in the first 6 weeks. But it's really given all that back, and it's pretty much flat to slightly down for the year as a whole, with a great deal of disparity within the overall performance. China lagging on the downside, and India being the star performer, up about 30%. So as we look into next year, the key construct here is that we think earnings growth will still be decent, not as strong as it was in 2021, where we think earnings growth will come in at about 33%, but still a credible 9% next year and then 10% the following year. And with valuations having compressed about 20% from their peak levels in mid-February to about 14.5, 14.6 times forward earnings now, that's roughly in line with what we think fair value is. So our basic view is that we think that markets can broadly climb their underlying or reflect their underlying earnings growth as they make another roughly 10% upside next year. And then the key aspect for investors is to have active tilts on top of that in order to be able to generate better returns than the underlying broader index for the region is likely to deliver.
Okay, how do you capture then that credible earnings growth? I know that you're favourable on a couple of sectors out there. So let's go through some of them. The banks, I guess that's a bit of a no-brainer there, given the fact that you're talking about higher interest rates as we move into, of course, the coming years. But at the same time, on the flip side of the coin, could higher rates also be damaging for the banks if we do see a pickup in, of course, non-performing loans? We know that if you look at some of the property markets around the world, buyers, investors there are particularly stretched, and higher rates could have a discernible impact on some of those investors and consumers.
Well, that's exactly right. And I think you have to be selective within the region. So as you correctly said, we're overweight the banks. That's one of our active views that we just changed in the piece, which we released just late last week. And I think the concept here, as you correctly identified, is that in an environment where rates are rising and the yield curve may steepen somewhat, that typically is very favorable for the financials. That's going to be especially the case, we think, in the ASEAN region, where the overall MSCI ASEAN index is still heavily weighted to the financials, about 35% weighting. And we think that the prospects there, as the region broadly comes out of the pandemic-inspired setback, will lead to significant increases in performance for the banks and less of a concern on the NPL or the credit stress side that you mentioned. For China, which we can discuss separately and where we've actually upgraded our view in a somewhat contrarian manner, within China, we're still somewhat more conservative on the banks because of their exposure to the property sector. But there are many other parts of the China market which we think will be favorable, specifically including the areas that will be beneficiaries of the common prosperity dimension, as well as some of the oversold technology stocks, which we think have pretty good risk-reward profile going forward.